An investment strategy is a set of principles that guide investment decisions. There are several different investing plans you can follow depending on your risk tolerance, investing style, long-term financial goals, and access to capital. Investing strategies are flexible. If you choose one and it doesn't suit your risk tolerance or schedule, you can certainly make changes. However, changing investment strategies comes at a cost. Each time you buy or sell securities, especially in the short term in non-sheltered accounts, may create taxable events. You may also realize your portfolio is riskier than you'd prefer after your investments have dropped in value. Before you begin to research your investment strategy, it's important to gather some basic information about your financial situation. Ask yourself these key questions. What is your current financial situation? What is your cost of living including monthly expenses and debts? How much can you afford to invest, both initially and on an ongoing basis? Make sure you can afford to invest before you actually start putting money away. Prioritize your current obligations before setting money aside for the future. Next, set out your goals. Everyone has different needs, so you should determine what yours are. Are you saving for retirement? Are you looking to make big purchases like a home or car in the future? Are you saving for your or your children's education? This will help you narrow down a strategy as different investment approaches have different levels of liquidity, opportunity, and risk. Next, figure out what your risk tolerance is. Your risk tolerance is determined by two things. First, this is normally determined by several key factors including your age, income, and how long you have until you retire. Investors who are younger have time on their side to recuperate losses, so it's often recommended that younger investors hold more risk than those who are older. Risk-reward relationship. Risk isn't necessarily bad in investing. Higher risk investments are often rewarded with higher returns. While lower risk investments are more likely to preserve their value, they also don't have the upside potential. Strategy 1: Value investing. Value investors are bargain shoppers. They seek stocks they believe are undervalued. They look for stocks with prices they believe don't fully reflect the intrinsic value of the security. Value investing is predicated, in part, on the idea that some degree of irrationality exists in the market. This irrationality, in theory, presents opportunities to get a stock at a discounted price and make money from it. It's not necessary for value investors to comb through volumes of financial data to find deals. Thousands of value mutual funds give investors the chance to own a basket of stocks thought to be undervalued. The Russell 1000 Value Index, for example, is a popular benchmark for value investors, and several mutual funds mimic this index. People often cite legendary investor Warren Buffett as the epitome of a value investor. Consider Buffett's words when he made a substantial investment in the airline industry. He explained that airlines had a bad first century. Then he said, and they got that century out of the way, I hope. This thinking exemplifies much of the value investing approach. Choices are based on decades of trends and with decades of future performance in mind. Strategy 2: Growth investing. Rather than look for low-cost deals, growth investors want investments that offer strong upside potential when it comes to the future earnings of stocks. It could be said that a growth investor is often looking for the next big thing. Growth investing, however, is not a reckless embrace of speculative investing. Rather, it involves evaluating a stock's current health as well as its potential to grow. A drawback to growth investing is a lack of dividends. If a company is in growth mode, it often needs capital to sustain its expansion. This doesn't leave much or any cash left for dividend payments. Moreover, with faster earnings growth comes higher valuations, which are, for most investors, a higher risk proposition. Growth investors also need to carefully consider the management prowess of a business's executive team. Achieving growth is among the most difficult challenges for a firm. Therefore, a stellar leadership team is required. At the same time, investors should evaluate the competition. A company may enjoy stellar growth, but if its primary product is easily replicated, the long-term prospects are dim. Strategy 3: Momentum investing. Momentum investors ride the wave. They believe winners keep winning and losers keep losing. They look to buy stocks experiencing an uptrend. Because they believe losers continue to drop, they may choose to short sell those securities. Momentum investors act in defiance of the efficient market hypothesis (EMH). This hypothesis states that asset prices fully reflect all information available to the public. A momentum investor believes that given all the publicly disclosed information, There are still material short-term price movements to happen as the markets aren't fully recognizing recent changes to the company. Despite some of its shortcomings, momentum investing has its appeal. For example, the MSCI World Momentum Index, which has averaged annual gains of 10.75% since its inception in 1994 through June 2022, compared to 7.59% for its benchmark over the same period. Strategy 4. Dollar cost averaging. Dollar cost averaging (DCA) is the practice of making regular investments in the market over time. Rather, it is a means of executing whatever strategy you chose. With DCA, you may choose to put $300 in an investment account every month. This disciplined approach becomes particularly powerful when you use automated features that invest for you. The benefit of the DCA strategy is that it avoids the painful and ill-fated strategy of market timing. Even seasoned investors occasionally feel the temptation to buy when they think prices are low only to discover, to their dismay, they have a longer way to drop. When investments happen in regular increments, the investor captures prices at all levels, from high to low. These periodic investments effectively lower the average per share cost of the purchases and reduces the potential taxable basis of future shares sold. And that's it for today.